Welcome everyone to 9/12 Financial Group's review of the 9/12 Playbook, March 2024 featured investor suggestion. Okay, let's review the March suggestion. Intel, we reviewed the chart, did our internal analysis, and decided the risk reward was there to suggest entering a bullish position with Intel at 43.82. We decided that a good place to put a stop was at the end of August 2023 lows and set a target for it to return to where it was trading prior to the recent 737 max issue. So our stop is 32.15 and our target is 49.52. So using that information, we produced our trade suggestion. Given where the stock is currently trading and our target and stop, we construct the position of buying an August 45 call, selling an August 50, and selling 2 August 35 puts. Why August? Because we are investing, and we target about 6 months for these investor suggestions. Now, you will notice that the suggestion makes note of a conservative trader. The conservative trader will utilize a stop, while the aggressive trader will not. When you enter this trade, you need to decide if you are willing to take ownership at the short put strike, because that is the risk of the strategy. It may seem counterintuitive, but featured investor suggestions benefit those who are aggressive in their desire to take ownership of the underlying via exposure to the 2 short puts if the underlying takes another leg down. Because while the conservative trader locks in a loss at the stop due to the increase in short put premium and the decrease in net long call premium, those who hold the position to expiration will benefit from premium decay. They will also benefit from that window of forgiveness between the long call and the short puts, where the position can expire without harm to the trader. There will be daily P&L swings, but the only way the aggressive trader can lose is if the stock closes below the short put strike on expiration, where he now becomes an owner at the level the trader intended to own the stock. It's this large window of forgiveness where we can be wrong and not lose money that makes this strategy unique. As for maintenance for this position, for the conservative trader, it's remarkably simple. Place an OCO, one cancels the other. Order to close the entire position should Intel trade either 32.15 or 49.52. Also have bids to close your short units at 5 cents good until canceled. For the aggressive trader, it's even simpler. Only place an order to close both call units should Intel trade 49.52 and let the short puts do what they will until you either get them back at 5 cents or they expire in the money and you own the stock. Both would close the long call should it close in the money on expiration day. The conservative trader wants 0 residual position at the end of the life of the trade. The aggressive trader would only have a residual position should they get assigned on the 35 puts prior to closing them at 5 cents. The margin usage should be the margin used to sell 2 August 35 puts. If you would like to reduce the requirement, you can buy further out of the money August puts, the 30s or the 20s, but that would increase the cost of the trade by the cost of 2 of those units. So this is our starting point. Okay, let's see what happened. Intel opened a little higher and you had to wait until March 5th for you to get filled on your 10-cent credit bid. At the end of March, Intel closed at 44.17. Your position closed at a 15-cent debit, and with the 10-cent credit at entry, you are up $25. During the month of April, the conservative trader was stopped on April 26th when Intel dropped below 32.15. When Intel traded 32.15, the conservative trader would have closed their position. They would have bought back their 2 August 35 puts, bought back their August 50 call, and sold their August 45 call, all for a net loss of $850. The aggressive trader, who doesn't set a downside stop, still retains their position. The aggressive trader looks at accumulation at the short put strike as an opportunity, not a punishment. Intel closed at 30.47. Your position closed at a 10.58 credit, and with the 10-cent credit at entry, you're down $1,048. during the month of May. The aggressive trader who would still be in their position was able to close the short August 50 call on May 9th for 5 cents. You did the trade for a 10-cent credit. Now your net credit has been reduced to 5 cents, but you then had unlimited upside instead of capping it at the short call strike. Intel closed at 30.85. The aggressive trader's position closed at a 9.25 credit, and with the 10-cent credit at entry, minus the 5 cents to buy back the call, you're down $920 at the end of June. Intel closed at 30.97. The aggressive trader's position closed at a 9.05 credit, and with the 10-cent credit at entry minus the 5 cents to buy back the call, you're down $900. At the end of July, Intel closed at 30.74. The aggressive trader's position closed at a 9.19 credit, and with the 10-cent credit at entry minus the 5 cents to buy back the call, you're down $914. At August expiration, Intel closed at 20.87. The aggressive trader's August 35 puts closed in the money, and with the 10-cent credit at entry minus the 5 cents to buy back the call, you're down $2,821. The option position will expire at 0. For accounting purposes, they all expire at 0. The question is always, when they expired, were they in the money and by how much? The August 35 puts closed in the money, so the owners of those puts exercised their right to sell you their 200 shares at $35, where the aggressive trader is now an investor. That $35 cost basis is why the aggressive trader sees an unrealized loss of $2,826 in his account in relation to his 200 shares. He will not realize a loss unless he sells his shares below $35 a share. If he holds his shares as he planned to do should he get assigned when he put the position on, and Intel rallies back above 35, he would turn this loss into a gain. And here's the lesson to be learned from this trade suggestion. Investing involves looking for good opportunities within the big picture, and good opportunities rarely look good at the time they are presented. The best investing involves initiating ownership when things look bad, identifying value at your entry price, and expecting future improvement in value, not in a day, a week, or even a month. And when we at 912 Financial Group make a featured investor trade suggestion, we operate under the premise that we are 100% okay with in fact. We desire ownership of the stock or index we are suggesting at the discounted levels the positions would produce should the short puts turn to ownership at their strike price. Unfortunately, sometimes you think a stock has dropped enough, and even though you think you built in enough cushion, a nice and wide window of forgiveness, it goes even lower. Sometimes the conservative trader, utilizing a stop to limit his risk, does better than the aggressive trader. That was the case this time when Intel took that surprise second leg down when it announced it would be cutting its workforce and suspending its dividend. In the end, where the conservative trader suffered an $850 loss and had no residual position, the aggressive trader suffered a net loss of $2,821, of which $2,826 was unrealized, and a residual position of 200 shares of Intel. Hopefully the worst is over, the cost-cutting works, and we can recoup those unrealized losses. That said, if you are viewing this review and are still not sure about subscribing, request a free 14-day trial edition at 12financialgroup.com. Or contact us with comments or criticism at 912financialgroup.com. Check us out at 912FinGroup on X. Have a great day.